Hi all, welcome to this tutorial. In this tutorial, we are going to discuss about introduction and purpose of financial statement. So this is a session from CMA USA Part 1, Financial Planning, Performance and Analysis. So in this session, we will discuss about the different financial statement and its purpose of different financial statement as well. So normally financial statements are prepared according to recognized frameworks such as generally accepted accounting principle and international financial reporting standard. So generally accepted accounting principle and international financial reporting standard are the two accounting standard which is normally recognized worldwide. So while preparing the financial statement, normally the accountant are considering any of these financial standards or reporting standards. The one is generally accepted accounting principle, that is US GAAP and international financial reporting standards. So by using these specific accounting standards, so it will become ensure comparability, reliability, transparency in the financial reporting. So by using these specific accounting standards, it ensures the financial statements are comparable, reliable and transparent in financial reporting. Topic overview. Financial statements are structured report that communicate a company's financial performance, position and cash flow. They are primarily communication tool between company and its stakeholders. So financial statements are primarily a communication tool between company and its stakeholders. So without financial statement, investors cannot evaluate its profitability. Investors are invested in the business for the profit. So without a financial statement or financial report, investors cannot evaluate the profitability. And creditors cannot assess the repayment ability. Managers cannot measure the performance. So there are different stakeholders for the financial statements, which may be internal and external. So without the financial statement, they cannot evaluate the company and make different financial or investment or strategic or any other type of decisions. So the financial statement exists primarily to support economic decision making. The primary objectives of financial statement is to support economic and profitable decision making process. So by end of this lecture, you will be able to understand, or should able to define the financial statement, explain the purpose of financial reporting, describe the decision making usefulness concept, identify four main financial statements which include income statement, balance sheet, statement of cash flow and statement of changes in equity. And also understand how these financial statements help stakeholders to evaluate a company. So this is the learning objectives for this lesson. So we'll move directly into topic. As we told, financial statements are formal records which is summarizing financial activities and financial position of a business on a specific period of time or specific point. So financial statement communicates information about, the first thing is profitability, then the financial position, liquidity and cash generation. The financial statement is telling a story about the profitability, financial position, liquidity and cash generation. The purpose of financial statement. First one, the provide information about financial performance. The key purpose of financial statement is to provide information about the financial performance. How companies performed financially in the last period or last quarter, last year, last month, 6 months, based on the requirement. So the key primary objectives of the financial statement is to provide information about a company's financial performance. Different stakeholders want to know, did the company earn profit? Are we operating inefficient? So there are a lot of questions which may ask different stakeholders. So the financial statements are the answer for these questions. Whether the companies make profit or are we operating efficient? What is our liquidity position? What is the cash position? All these things, all these questions will be answered by the financial statements. Here you can see in the case a company has a revenue of 2 million, expense 1.7 million, so the net income will be 300,000. That is revenue minus expenses. So in this case, we can say that this case is a profitable case because the total revenue is exceeding total expenses. So this is answering a simple question: is this company's or this case is making a profit or a loss? When it's come to balance sheet, it will answer a different question. What is the financial position of a company during this period or during a point of time? When it's come to cash flow statement, it will answer a different question like what is the cash flow position of a company during a period of time. So when it's come to different financial statement, it answer different questions and which is very relevant for various stakeholders to make different decisions. The second thing, show financial position. Financial statement show what a company owns and owes. That means if you are looking into the balance sheet, which is mainly focusing on the financial position, that means which is telling what is company owns and what is its owes. This helps the companies assess the financial stability and the financial risk, how risk is involved in the business, in this business, which will answer by the balance sheet statement or statement of financial position. Then provide cash flow information. Again, when it's come to profit is always not ensure the cash availability. The cash flow statement will define where the cash from how it was used. So cash flow statement will answer these two questions: from where company receives the money and how company spend that money. This will answer by the cash flow statement. Then support decision making process. Definitely financial statement will help the different stakeholders to decide whether to invest in this company. For an investor point of view, he can decide whether he can invest in this company or not. If you are a creditor, you can lend or money or not. If you are a management person, you can decide whether this operation is profitable, you can expand or not. So which will support, this is a primary tool for decision making support. The financial statement acts as a primary tool to make the different decision making process. Then decision usefulness concept. Decision usefulness concept states that the financial reporting should provide information that help users to make economic decisions. So the decision making concept will be the first thing, it will be relevant. Usefulness information must be relevant. That means which help the predict outcome. Then reliable. The information should be reliable and accurate. Comparable. That means which should be able to compare with the previous period. Then the understandable. So these are the some characteristics of financial information must be how the financial information should be presented in the financial statement. It should be relevant, reliable, comparable, and understandable. So now let's move into key for financial statement. So definitely the first one is income statement. The second one is balance sheet, statement of cash flow, and statement of changes in equity. So these are the key for financial statement that everyone should understand. The income statement. Income statement, it is show the profitability over a period of time. That means which report the total income and total expense for a period of time. So the total income minus total expense is the net profit. Then the balance sheet. Balance sheet show the financial position at a specific date. So how much the company liable and what are the company's asset, what are the company's liabilities. So which tell us the financial position of a company on a specific date of time or specific point of time. Then the statement of cash flow. Statement of cash flow defining or it is reporting the total cash inflow and total cash outflow for a period of time, which report how the cash come into the company, what are the sources of the cash inflow and what are the sources of the cash outflow. The cash flow statement report these sources and this spending also. So which will tell us the company from where the cash are coming or from where the company spend those money. So again in the cash flow statement which is categorizing its activity into three. the operating activities. That means how much money comes from the company's core business operation and how much money is spent on core business operation. Then the investing activities. That means anything related to investment. How much money comes from the investment or how much money go out for the investment. Then the financing activities. Financing activities mean all activities related to financing the company. So how much money came from the financing activities and how much money goes out through financing activities. So in the statement of cash flow, which categorize the total business activity into three, which is operating activities, investing activities, and financing activities. Then the statement of changes in equity. Statement of changes in equities, it show changes in owner equity caused by profit, dividend, and net investment. So which will show the changes in owner's equity over a period of time. That means how much will be the total beginning equity, what will be other changes like the net income, dividend, and ending equity. It will come with the ending equity. So the statement of changes in equity show the owner's equity, changes in the owner's equity during a period of time. So let's look into this case. A bank is evaluating whether to provide a loan to Beta Manufacturing. The bank review balance sheet, income statement, and cash flow. Why does bank need all this? Because each statement provides different information. The income statement provides the profitability, balance sheet provides the financial position, and cash flow statement provide cash generation ability. So in the case of a bank, all these are relevant. The company should be profitable and should be financially good, in a good position, and also it should be able to generate the cash during its for the interest payments. So as a banking point of view, all these financial statements are relevant to them to make a decision whether to grant them a loan or not. So like this, there are different stakeholders are there. So for all stakeholders, there are particular interest for them in different financial statements. So to make their various decision or to support their process, they are normally referring into financial statements. Just look into this case. A company reports high profit but negative operating cash flow. The question, which statement reveals this issue? This is statement of cash flow. If you look into the income statement, you can see only the profit, not the cash flow. If you are looking into cash flow statement, which will reveal how much cash come in, how much cash go out. So which will reveal this issue. That means if some companies, some cases which will make high profit, but the negative operating cash flow also happens. So this is a fail in the cash collection. So let's move into the multiple choice practice. The first question, the primary objectives of financial reporting is to, option A, provide tax information, then assist users in economic decision making, C, calculate company's profit, and record daily transaction. So previously we already discussed the key objectives of financial statement is to assist the users in economic decision making process. Then let's move into question 2. Which financial statement report the financial position at a specific date? Option A, income statement, option B, balance sheet, cash flow statement, and statement of changes in equity. So previously it is balance sheet or statement of cash position which reveals financial position of a company on a specific particular date. So we are concluding this discussion. So before concluding, just a summary part is available here. First one, the financial statement. What are the financial statement? It is a communication tool of financial information to different stakeholders. Then the key main objectives of in decision making is the key objectives of financial statement is decision usefulness. The key financial statements are income statement, balance sheet, cash flow statement, and statement of changes in equity. So together, all these financial statements provide a complete financial picture of a company to different stakeholders. So these are the quick summary for today's discussion. So what is the financial statement, and definitely which the purpose of financial statement. The key purpose of financial statement is to support the decision making process, And the key financial statements are income statement, balance sheet, cash flow statement, and statement of changes in equity. So this is about today's discussion. If you have any doubt or you need any clarification on any of these topics, please ask me on the comment section. Thank you for watching this video.